Shares in commodities fell again as investors sought refuge from the political turmoil fueling fears of Greece's exit from the Eurozone and threatening to undo progress made so far to solve Europe's debt crisis. I caught up with Clyde Rossouw from Investec Asset Management and asked him for his views on the Eurozone and its banking system.
At the end of the day, what we're interested in, we're interested in buying businesses that are of high quality, therefore the balance sheet is sound, and we know that those businesses will still be around years from now, whereas some governments might not be able to say the same thing with confidence. The second thing is we do think that there's a growth opportunity in these businesses because they make products or sell services that everybody needs and can't do without. And thirdly, they do offer a reasonable yield, which I think, in an environment where cash is giving nothing, you have to do something with your money. So that's really what we think could be effective.
The developed world is a big place. So when you talk about opportunities, where are the clear geographic opportunities that you're seeing?
Geographically, what we're finding is, and this is as a result of the ideas that we're finding sort of as we look at on a company level, are still predominantly domiciled in the US. And interestingly enough, in Europe, there are a lot of European companies that are really good businesses, and you can see by the way the shares perform. Those shares don't go down when bad news happens in Europe, whereas the market is, in our view, correctly discriminating against the good and the bad. So we're finding a lot of opportunities in both Europe and in the US, but I think it's more important to look at the type of companies that we're looking at. And as you pointed out earlier, a lot of them are found within either the consumer staples sector or within the pharmaceutical sector, but there are a lot of technology companies that also interest us at this point.
And do those companies in the developed world have a strong emerging market bias? So they're based in the developed world but operate in the emerging environment?
Absolutely, and I think the most important thing that investors should look at is businesses that have a strong domestic franchise but with an additional growth opportunity in emerging markets. So what we want businesses that have big exposures to the growth areas in the world, and we wouldn't be alone in arguing that there are big growth opportunities in the consumer space in the emerging world. But what we're saying is do you want a strong domestic franchise, a business that's still growing and compounding its profits, it's got exposure to the growth opportunities, but doesn't bear the same degree of currency risk? Because the biggest challenge behind investing in emerging markets is the amount of money that you tend to lose on the currency.
Oh, you just look at the rand volatility at the moment, trading at around 8.15 to the dollar, and pretty tantamount to a blowout if we hit that 8.60 level.
No, absolutely.
Clyde, just in conclusion, there are opportunities in the developed environment. The hottest opportunity that you see at the moment?
I think I would always hesitant to highlight one stock, because I do think that whatever stock we might mention would end up could do whatever. But I'm going to give you two or three. I mean, the stocks that we like at the moment, we like Microsoft. I think it's an IT company that you're paying virtually nothing for, 10 times earnings, 10% free cash flow yield, growing franchise, business is re-engineering itself. We quite like that as an opportunity. We like Nestle. It's the world's largest food company. It's a phenomenal company. It's plugged into the areas, the growing parts of the world, particularly in consumer healthcare and nutrition, and it really is a well-managed business. It happens to be listed in Switzerland, which also means that there's always an element of safety around a Swiss firm, and we like the corporate governance in the business. And I know corporate governance is not something that people like to talk about, but when it's lacking, you can really lose a lot of money. So those are two examples.
Very comprehensive update from Clyde.
Clyde is a very, very well-experienced asset manager. He truly is. And his broad theme, I couldn't agree with more. They're actually very cheap shares in Europe and the US at the moment. And on balance, quite frankly, in my opinion, the shares are cheaper than the average South African share. I'd way rather buy Nestle at their rating and go and buy Tiger Brands at an 18 rating, or buy ShopRite at a 26 rating. They just are cheaper, but that doesn't mean you make money from it for maybe 6 months, maybe 3 years. But you are clearly buying value if you buy these mega global companies at very, very good ratings. I mean, the shares are cheap, but of course the problem is no one wants to touch them because there's trouble in Europe. And what people, I think, fail to understand, and maybe the biggest single lesson I've ever learned about investments, things aren't cheap when there's good news around it. Things are only cheap when there's bad news.